welcome back to Money Talks, your trusted guide through the world of finance. We're so glad you've joined us again. If you're finding these conversations valuable, do us a quick favor and share this episode with your friends and colleagues. And for those of you studying for the Canadian Securities Course exam, don't forget to visit mtalks.ca to get your copy of our study guide and mock test today. It's the perfect tool to champion the CSC exam and start that wonderful path toward the next level of success in your career. Today, we're diving into a topic that sounds complex but is fascinating when you break it down: structured products. And to help us navigate these waters, we have financial professional Jonathan Cartier back with us. Welcome, Jonathan.
Thanks for having me, Rita. It's great to be here.
So, Jonathan, structured products, it's a term that can make some people's eyes glaze over. In simple terms, what are we really talking about?
That's a great place to start. Think of a structured product as a pre-packaged investment strategy. It's created by financial institutions, usually the big banks, to offer a specific risk and return profile that you couldn't easily get from traditional investments. They take underlying assets like a basket of stocks, mortgages, or even car loans, and financially engineer them into a new security. The goal is often to provide higher returns than conventional investments or to offer some form of protection on your initial investment.
Okay, so it's like a custom-built investment. What are the main advantages of going this route instead of just buying, say, a regular stock or bond?
There are a few key benefits. First, diversification and access. An individual investor probably can't go out and buy a pool of 1,000 mortgages, but a bank can. They bundle these assets, giving you a piece of a much larger, diversified pie. This process is called asset securitization. It also often comes with professional management and economies of scale. And a big draw for many is the potential for principal protection. It's highly likely, though not always guaranteed, that you'll get your initial investment back at the end of the term.
That sounds appealing, especially in a volatile market, but I'm sensing a but coming. What are the downsides?
You're right to sense that. The biggest disadvantage is complexity. Because these products are so engineered, it can be tough for the average investor to truly understand the risks involved, especially when derivatives are part of the structure. Another major issue is illiquidity. Unlike a stock you can sell anytime the market is open, structured products often have a very thin secondary market, if any at all. You should be prepared to hold them until they mature. And finally, the costs. There can be a whole host of fees, management, structuring, performance fees, that create a significant hurdle you have to overcome before you see a decent return.
That makes sense. Let's get into some specific examples. One of the most common ones I hear about is the Principal Protected Note, or PPN. How does that work?
PPNs are very popular in Canada and are issued by the big six banks. In essence, a PPN is a debt instrument that promises to return your principal at a set maturity date, which could be 3 to 8 years down the road. The interesting part is the return, or interest, isn't fixed. It's linked to the performance of an underlying asset, like the S&P/TSX 60 index or a basket of stocks. The bank guarantees your principal, but the interest payment is variable and depends entirely on how that underlying asset performs.
So you get the safety of knowing your initial investment is protected, but also the potential for stock market-like gains. How do the banks structure this to make it possible?
It's a clever structure called the Zero Coupon Bond Plus option. When you invest, say, $10,000, the bank takes the majority of that money and buys a zero coupon bond that will mature to exactly $10,000 on the same date your PPN matures. That's your principal guarantee. With the small amount of money left over, they buy an option on the underlying asset. This option gives you the exposure to the market and provides the potential for that extra return. If the market goes up, the option pays off. If it goes down, the option expires worthless, but your zero coupon bond has grown to cover your initial principal.
That's a great way to visualize it. But is it a one-to-one return with the market? If the TSX 60 goes up 50%, do you get 50%?
Not usually. This is where investors need to read the fine print. The return is often limited in one of two ways. First is a participation rate. For example, the PPN might offer a 75% participation in the index's return. So if the S&P TSX 60 goes up 40%, your return is 30%. The second method is a performance cap. The PPN might give you 100% of the index return, but only up to a maximum of, say, 35%. Anything above that, you don't participate in. It's the trade-off for having that principal protection.
Before we move on, let's pause for a moment. For all our listeners dedicated to acing their financial exams, remember that understanding these nuances is key. Head over to mtalks.ca to grab our study guide and mock test. It's designed to help you master these concepts and take a confident step forward in your career. Now, Jonathan, another product that sounds similar is a market-linked GIC. How is that different from a PPN?
They are very similar in concept, but with a few key differences. Like a PPN, a market-linked GIC guarantees your principal and links to return to an underlying asset like a stock index. The main distinction is that market-linked GICs are actual GICs issued by a bank and are insured by the Canada Deposit Insurance Corporation, CDIC, whereas PPNs are not. This gives them an extra layer of safety. However, GICs are typically non-redeemable, meaning you are locked in until maturity, whereas some PPNs may offer a chance to redeem early, though it might not be at a favorable price. The tax treatment is also straightforward. Any gain is taxed as interest income in the year of maturity.
Let's switch gears to something that sounds a bit different, split shares. What's the story there?
Imagine you and a friend buy a dividend-paying stock together, say a major Canadian bank stock. You want the steady dividend income, but your friend is more interested in the potential for the stock price to go up. A split share corporation does exactly this on a larger scale. It buys a portfolio of blue-chip dividend-paying stocks and then issues two types of shares against that portfolio: capital shares and preferred shares.
So one for income, one for growth?
Precisely. The preferred shares are for the income-focused investor. They get a priority claim on all the dividends paid out by the underlying stocks. In return for this steady income stream, they give up the potential for capital growth. The capital shares are for the growth investor. They get all the capital appreciation of the portfolio above a certain value. They sacrifice the dividend income in exchange for a leveraged bet on the stock prices.
Leveraged? How does that work?
Let's use an example. Imagine a stock is trading at $50. A split share corp buys it and issues one preferred share for $25 and one capital share for $25. Now, if the stock price goes up by $5 to $55, that's a 10% gain for someone holding the original stock. But for the capital shareholder, who only invested $25, that $5 gain represents a 20% return. It magnifies the gains. But, and this is critical, it also magnifies the losses. A small drop in the underlying stock's price can wipe out a significant portion of the capital share's value.
That sounds like a much higher risk proposition for the capital shareholder. What about the other side of this coin, asset-backed securities? This is where we hear terms like mortgage-backed securities.
Exactly. This is the securitization process we touched on earlier. Let's take mortgages. A bank has thousands of mortgages on its books. These are assets, but they're not liquid. The bank has to wait years for the cash to be paid back. To free up capital, the bank can bundle a large pool of these mortgages together and sell them to a separate legal entity called a special purpose vehicle, or SPV.
A what?
A special purpose vehicle. Think of it as a separate company created for one purpose only, to hold these assets. This SPV then issues securities, mortgage-backed securities, or MBSs, to investors. The investors who buy these securities now receive the monthly principal and interest payments from that pool of mortgages. The bank gets its cash up front to go out and issue more loans, and the investor gets a steady, income-producing investment.
In Canada, what makes these attractive?
The key feature of most mortgage-backed securities in Canada is that they are backed by mortgages insured by the Canada Mortgage and Housing Corporation, the CMC. So they effectively have a government guarantee on the timely payment of principal and interest. So you get a yield that is typically higher than a Government of Canada bond with a similar level of security.
But there must be unique risks. I've heard the term prepayment risk.
That's the big one, especially for MBSs containing open mortgages. Prepayment risk is the risk that homeowners will pay back their mortgages faster than expected, especially when interest rates fall. Imagine you bought an MBS yielding 5%. If rates drop to 3%, homeowners will refinance. They pay back their old 5% mortgages, and that principal is returned to you, the MBS holder, much earlier than you planned. Now you have to reinvest that money, but you can only get the new, lower rate of 3%. It's a significant risk to your expected return over the life of the investment.
That's a fantastic breakdown, Jonathan. We've covered PPNs, market-linked GICs, split shares, and asset-backed securities. As we wrap up, what's the one key question an investor should ask themselves before considering any of these structured products?
The most important question is, do I truly understand what I'm buying? Understand the underlying assets, understand how your return is calculated, understand all the fees involved, and most importantly, understand the risks, especially around liquidity and performance caps. These are not your everyday stocks and bonds, and they require an extra level of due diligence.
Excellent advice. Thank you so much for clarifying these complex topics for us, Jonathan.
My pleasure, Rita.
And to our listeners, thank you for tuning in to Money Talks. We hope this discussion has empowered you with new knowledge. If you found it helpful, please like, subscribe, and share it with someone who might benefit. And for those on their professional journey, make one final stop at mtalks.ca to get your copy of our study guide and mock test. It's your partner in preparing for the CSC exam and launching the next successful chapter of your career.